in terms of global equities, I mean, there's a lot of underperformance across the board. You know, what's happening globally? Why no, there's hardly any good funds at the moment performing well across the board.
Yeah, and Russia's the thing that's caused that. The Russian invasion of Ukraine took the markets by surprise, and the cutting off of energy and the increase in energy prices. We were at 60 odd dollars a barrel a year or so ago. We're near 100 today, and we've been over 100. The threat of cutting off supply to Europe, the impact on the European stock market. You've seen all of the trouble in Europe. You've seen the trouble in the UK. Part of it's their own making, but all of that is not predictable if you're a stock picker. And so a lot of managers were underweight the energy companies because if you think about climate change, etc., you know, what's their future? And so a lot of them were overweight other parts of the market and really underweight that. Well, those stocks just took off in the first half of the year. And so a lot of managers, whether they'll value or growth, underperformed dramatically.
So even, you know, we talk about diversification, the Future Generation global portfolio is diversified, but it hasn't performed as well as we would have expected. I mean, obviously we don't have that much in terms of energy stocks in there, but why else hasn't it performed?
I think some of our absolute return managers and our long short managers haven't done as well as we would have hoped, and we've been quite disappointed in some of their performance, and that's part of the reason why we're doing a little bit of restructuring at the investment committee.
So the investment committee has been meeting incredibly regularly. Yes. So how are you rebalancing the portfolio?
We're adding more managers. We're downweighting some of the managers that we've been very disappointed in, and we're improving what we think the mix of management going forward. We're going to reduce our risk across the portfolio, and I think we're introducing some really interesting managers. Some of those managers are managers that we have in FGX who have moved into the global space, and we're taking advantage of our knowledge of them and the way they've run their assets here in Australia. And so we're basically looking to introduce those guys in a way to dampen down the volatility and improve our net returns into the future.
So we now have 14 boutique fund managers in the portfolio, and obviously we've just introduced Plato, Lanyon, Vinva and Wisco. So tell us about those, because obviously Vinva is from the Future Generation Australia portfolio. So Plato and Vinva, I mean, they're sort of quant. Why is that going to be good for the portfolio?
It will dampen down our volatility because it'll give us more stocks basically across the portfolio. They're more index aware, as quants are, but that doesn't stop them picking stocks or, you know, moving the portfolio around. It just basically means that they're more risk controlled. They take a little bit of the risk out in terms of sector bets and country allocations, and so that's a good thing for the portfolio. It gives us a more rounded portfolio. So we're in, I think, really good managers there who we've had really good experiences with. Vinva in particular have a history of, you know, Maury Wakehead was head of BlackRock's global portfolio team before he left BlackRock. So he has an experience in global equities.
So tell us a little bit about Wisco and Lanyon as well, because obviously Lanyon is also in the Future Generation Australia portfolio.
So Lanyon's unique in a sense because they're very concentrated portfolio, but with a true valuation bias. We've probably lacked that in the portfolio. We've probably had a little bit too much growth in the portfolio. So the introduction of him is into the portfolio is going to be quite interesting from our perspective. We've put him in at a modest way because it's a new strategy. Mark Wisco used to be the head of Franklin Templeton way back in the late 90s, early 2000s. He was one of the reasons why in the tech wreck, Franklin Templeton did so well. And Mark decided after those days that he would go out and start his own funds. He's been a very successful investor in long-short portfolio for 20 years. I think we're just so fortunate that Mark wants to give back to Australia and is happy to be a manager in the lineup. It was really inspiring when we did the interview with him that was really one of his big focuses, was that he wanted to give back to the Australian community because Australia had been really good to him. He's had long-standing relationships with some of our clients. He has performed as you would expect for a long-biased absolute manager. He's done particularly well over a very, very long period of time.
So how is this going to have a long-term impact in our portfolio?
I think we balance up our growth value exposures, and I think we're bringing ourselves to be more like FGX in construction. We've got more diversification across managers, more stock picking. We're not as reliant on one or two of the managers, and I think that's a really good thing. And I think we're just repositioning to improve the outperformance going forward and to be more robust in market downturns. I think we were pretty disappointed in the last 12 months that we didn't perform better, given that we've got absolute bias managers there and long-short managers. So,
I mean, there obviously has been a fair bit of change in the last 6 months in the portfolio. So how's this actually going to affect the stock composition?
Oh, we'll just have more stocks. And I think we probably may in our next newsletter come out and talk about how it looks going forward in terms of our allocation to the various sectors, where energy, etc., countries. That might be some information that our investors would be really, really interested in. But look, let's just say we're narrowing the
I mean, I think a lot of our investors are, very much focused on the portfolio performance, but the fact that we have the dividends and the yield.
Oh yeah, absolutely fantastic, right? Because if you look at any of our competitors who, multi-manager, their dividend yields probably 1% or something like that at most, because we've ensured that we're going to pay a reasonable dividend to investors who need to basically live off the dividend.
And also having a profit reserve helps.
Correct, absolutely.
So tell me, you're an investor in both of these companies. Mm-hmm. Why do you invest in both of them, and how does it play within your portfolio?
So it sits in my self-managed superannuation fund. And it really plays a sort of core role in my Aussie equities and global equities portfolios because of two things. One, they're very diverse and they're quite different to me just going out and picking one particular manager, so I get a spread of managers. And B, the dividend yield's fantastic. And so, a fully franked div yield like that is really helpful. I might retire soon, maybe not.
As long as you're still on the investment committee. But thank you very much, John, for your time. Thank you.
Thank you, Caroline.